Hello everyone and welcome back to the sessions on financial reporting. Friends, in this class of financial reporting, we are continuing with the topic Ind AS 103, that is business combination. This is the third lecture on business combination. Friends, if you can recall, in the previous class, we have talked about certain steps involved in the acquisition method, that is the acquisition method of accounting for business combinations. The first step was to identify the acquirer. We have learnt in details about identification of acquirer or identification of the acquiring entity. The second step in that process is identification of the acquisition date. That is what we are going to start the class with. Identification of acquisition date is also very important step. Now friends, you must obviously understand one thing, that the whole process of business combination, it is not about going and buying some small commodity, it is acquiring a complete business. So don't you think that it will be a stage by stage, date wise, big span of whole negotiation. There will be a date on which you approach some entity which you are interested in taking over. You put some offer, there will be bargain, there will be some kind of negotiation, then the shareholders of both the companies should agree with the arrangement. Everything has to be legally worked out, all legal compliances have to be fulfilled, the shareholders have to be accordingly informed. It's a long process, right? So one particular date in this entire process will be identified as acquisition date. And that date is such an important date because that is the date on which the recognition and measurement will be made by the acquirer of the acquiree's assets and liabilities, and therefore that is the date on which you have to make all the calculations also. The calculations relating to the fair value of assets acquired, the fair value of liabilities assumed, the fair value of any equity instrument or any other security issued, the fair value of any kind of other settlements that are due or supposed to be made. So friends, acquisition date is very important date, and therefore identification of that acquisition date becomes an important step in the process of acquisition, or I would say within the acquisition method, this is a very important step. So how do we identify which date is the acquisition date? The straight criteria, so that you cannot have any confusion, is the date on which the acquirer obtains the control over the acquiree's business. So it is very clear, the date on which the control is obtained. So friends, there may be lots of dates available, you have to just look into one thing, which is the date on which the control is passed. Now, from a general perspective, what happens in usual circumstances, there will be all the settlements gradually happening, and finally a date will come when consideration is settled, when assets and liabilities of the acquiree are assumed by the acquirer or taken over by the acquirer, and that date is the date of final settlement. We generally call that date as a closing date. So in most circumstances, you will find that such closing date becomes the date of acquisition. However, it may happen that the date of final settlement and the date on which the control is obtained may not be same, they are different. In such case, you have to stick to the date on which the control is obtained. In such case, the issuance of consideration or the settlement of consideration can be just a payment course, and therefore which cannot be considered as the acquisition date. So one thing that you have to keep in your mind is the date on which the control is obtained by the acquirer will be considered as the acquisition date. So friends, what I am going to do is, I am going to give you some important notes in this regard, and we solve some case study based questions to have more clarity, and once we are done with this, we then step into the main part of the chapter today. So let us do one thing, whatever we have discussed, pay attention on the screen. I give you some notes and some follow-up questions. So friends, as we have just discussed, the acquirer shall identify the acquisition date, which is the date on which the acquirer obtains the control of the acquiree. It is generally the date on which the acquirer legally transfers the consideration, acquires the assets and assumes the liabilities of the acquiree. It is generally referred as the closing date. However, the acquirer might obtain control on a date that is either earlier or later than the closing date. An acquirer shall consider all pertinent facts and circumstances in identifying the acquisition date. So friends, do one thing, write up these notes quickly and then I take you ahead. Alright friends, you would have finished writing these notes. Let us move ahead and write something more about acquisition date. The acquisition date determines when the acquirer recognizes and measures the consideration, the assets acquired and liabilities assumed. The acquiree's results are consolidated from this date. The acquisition date materially impacts the overall acquisition accounting, including post-combination earnings. The acquisition date is often readily apparent from the structure of the business combinations and the terms of agreement, but it is not always the case, and that is why I told you you will have to deal with some case study based questions for better understanding. But first what you do is write down these notes quickly. Alright friends, you would have finished writing these notes. Let us move ahead and now take up question number 18. Let us read this question. Company A acquired 80% equity interest in Company B for cash consideration. The relevant dates are as under: date of shareholder agreement 1st June 2019, appointed date as per shareholders agreement 1st April 2019, date of obtaining control over the board representation 1st July 2019, date of payment of consideration 15th July 2019, date of transfer of shares to Company A 1st August 2019. So what is your task over here? The question is asking you to identify the acquisition date. If the question is asking you to identify the acquisition date, out of these dates, one of the dates has to be the acquisition date. Look into one thing, which date the control is obtained. Very clearly given in the question, date of obtaining the control over board representation is 1st July 2019. Friends, in most circumstances, if I am knowing this date, I will not even bother to look into other parameters and other information given in the question. So we have just roughly read the whole question, but we are very clear that date of obtaining the control over the board representation will be considered as the acquisition date. And do you notice one thing? It is a date different from the payment of consideration. It is a date different from the date which is appointed date as per shareholders agreement. So friends, it is the date on which the control is obtained which you have to consider. Let us see how to write up the answer for this question. In this case, as the control over financial and operating policies are acquired through obtaining control over the board representation on 1st July 2019, it is this date that is considered as the acquisition date. It may be noted that the appointed date as per the agreement is not considered as the acquisition date, as the company A did not have control over company B as at that date. So friends, please take note of this answer and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now take up question number 19. Let us read this question. Can an acquiring entity account for a business combination based on a signed non-binding letter of intent where the exchange of consideration and other conditions are expected to be completed within 2 months? Now this is the question asked to you. So biggest criteria that you have to consider is there is a date on which a letter is signed. Look into the nature of the letter. It's a non-binding letter of intent. You have just disclosed your intent. There is no transfer of control. It is all about transfer of control. If transfer of control happens, then acquisition date is arrived. If not, acquisition date is not arrived at. So let us see how to write up the answer for this question. You would simply write no. As per the requirement of Ind AS 103, a non-binding letter of intent, that is LOI, does not effectively transfer control, and hence this cannot be considered as the basis for determining the acquisition date. Note down this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the next question, that is question number 20. Let us read this question. On 1st April, X Limited agrees to acquire the share of B Limited in an all equity deal. As per the binding agreement, X Limited will get the effective control on 1st April. However, the consideration will be paid only when the shareholders' approval is received. The shareholders' meeting is scheduled to happen on 30th April. If the shareholders' approval is not received for issue of new shares, then the consideration will be settled in cash. What is the acquisition date? Now friends, again it is very simple criteria to be applied over here. Look into one thing. What is clearly obvious that the 30th April date, this date is the date on which the consideration will be settled. But you can see one thing, X Limited will get the effective control on 1st April. So what is to be dependent on 30th April? The shareholders meeting will be able to decide whether the settlement form should be shares of the acquiring company or should the consideration be settled in cash. So just the mode of settlement of consideration is yet to be decided. Control has effectively been transferred on 1st April itself. So the acquisition date will not be 30th April but will be 1st April. Now friends, many students can confuse themselves and write up 30th April because this appears to be the closing date. So don't always blindly take closing date as the date of acquisition. Always look into the fact which date the control is transferred. So let us see how to write up the answer for the same. In your answer you would write the acquisition date in the above case is 1st April. This is because in the above scenario, even if the shareholders don't approve the shares, consideration will be settled through payment of cash. So conclusion is what? The acquisition date remains 1st April itself. Quickly take note of this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and talk about the next concept, that is determining purchase consideration. Now friends, two things done, right? We have identified who is the acquirer. We have identified which is the acquisition date. Now the next step what we have learnt in the acquisition method is actually titled as recognition and measurement of certain components like assets acquired, liabilities assumed, any kind of non-controlling interest arising, and any kind of goodwill or gain on bargain purchase. But friends, all those calculations are directly linked with determining the purchase consideration. If the amount of consideration goes wrong, your other interrelated calculations will also go wrong. So it is important for you to understand how to determine the consideration for acquisition. So first thing, by notion you should be clear, the consideration has to be measured at fair value. That thing you punch in your mind, that consideration has to be measured at fair value. Once you are clear with that, then think of what all can you provide to settle the consideration. You may provide cash, you may provide other assets, you may provide the settlement by way of issuing either equity shares or other securities like debentures or bonds of your company. In such cases, what you have to do is always stick to one thing, that is fair values. So you have acquired the net assets of that acquiry. The net assets of the acquiry will be measured at fair value, that is one thing, and the consideration that you are settling will also be measured at fair value. So everything that you are giving away will be measured at fair value. So number one component would be any kind of cash payment. Number two, if any asset is transferred, its value should be considered as fair value. If that asset other than cash has a fair value which is different from the carrying amount in the books of the acquirer, then the difference between the two shall be recognized as gain or loss in the statement of P&L. Let me explain this by way of an example. Suppose I have taken over a business and the consideration for that business is being settled by transferring a land that I own. Now the land that I own has carrying amount of rupees 30 lakhs in my books, but the fair value of the land is rupees 40 lakhs. So as per the requirement of Ind AS 103, when I am handing over the land, when I am transferring the land, the value that I should consider will be its fair value, that is rupees 40 lakhs. So the difference between the existing carrying amount, that is rupees 30 lakhs, and the fair value, that is rupees 40 lakhs, that 10 lakh of difference will represent the profit arising on transfer of land, which must be immediately recognized in the statement of P&L. But under any circumstances, you are not going to take any amount other than fair value. So you will consider the fair value of the assets that you have transferred. If you have assumed any liabilities, those liabilities also should be assumed at fair values. Now, one important thing that you should consider, if you are settling the consideration by issue of shares or debentures or bonds of your company, then those also should be measured at fair value. So if you are settling the consideration by issue of equity shares or by issue of debentures, then the issue price should be the fair value of that instrument in the market that day. And when I say that day, means it is the acquisition date. All these fair values that we are considering for determining the consideration are to be obtained as on the acquisition date and not any other date. That is why determining acquisition date was so important. Now suppose you are issuing some shares and the shares are at a fair value of rupees 80 per share, but the face value of that share is just rupees 10. It is obvious that difference between 80 and 10, 80 is the fair value, 10 is the face value, the difference between these two will be considered as securities premium arising on issue of the shares. Same thing will happen when you are issuing any other securities like debentures or bonds. Now friends, whatever I have discussed, I will give you the same thing in writing, but one thing that you should consider, there may be other components of consideration which I have not discussed on purpose because I don't want to create that confusion. But while you are writing notes, you will have to write the complete note. So there will be something called contingent consideration, there will be something called deferred consideration, there will be some other type of consideration components which will come and which I have not discussed. So while writing the notes, if you come across those points, do not bother about those. You will be writing those notes just right now. Later on, we are going to discuss those components in detail. Whatever I have just discussed, I am putting the same thing on the screen. Please pay attention and note it down. So friends, as we have just discussed, it is about determining purchase consideration. So here we begin with fair value of assets transferred on acquisition date. We also consider the fair value of liabilities assumed on the acquisition date. Third thing, we consider the fair value of shares and other securities issued again on the same date, that is acquisition date. Then the next component that we have to consider is the present value of deferred consideration, if any. Now first of all, we have yet to talk about deferred consideration. Deferred means the delayed consideration, right? So if there is any delayed consideration which we have yet to discuss, we will definitely take the present value, because that payment is supposed to be a future payment. What you would consider is the present value of such payment, and we call that as present value of deferred consideration, if any. That will also be part of the purchase consideration. Now fair value of any contingent consideration, if it arises, again this is the point we have not discussed. We will be discussing this point later in details, but if you come across anything like this, it will also be part of the purchase consideration. Then any other consideration, again there may be certain components of consideration which we have yet to discuss. So everywhere where I have placed star mark, you also put the same and you write over there discussed later. So friends, do one thing, write up this whole thing and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up some important notes, and these points we have already discussed. Point number 1, when assets are transferred at fair value, the difference between carrying amount and fair value shall be recognized as gain or loss in the statement of P&L. When securities are issued at fair value, the difference between face value and fair value shall be transferred to securities premium. If the amount of purchase consideration includes separate transaction cost, then such transaction cost shall be separately charged to P&L. So friends, note down these points and then we shall move ahead. Alright friends, you would have finished writing these important notes. Let us move ahead and now talk about the next important concept, that is goodwill recognition and measurement. Now friends, in this regard, the concept is very simple if you understand it logically. If you have acquired a business and you have paid a consideration which is more than the net asset value that you have taken over, that means the amount of consideration paid is higher than the net asset value that you have taken over. So fair value of net assets, what you have taken over, more than that is the amount of consideration that you have paid. So why did you pay something in excess? Because what you have acquired is at fair value. If you have paid something more than that, means you have paid something more than the fair value, and that counts for goodwill of that business that you have taken over. So in simple words, there will be a running business which you have taken over. Along with the assets and liabilities of the business that you have taken over, you also take over its operations. Because you have taken over its operations, you take over its profit earning capacity. That means right from day one, that business is going to provide profits to you, and that is where you pay a premium to the acquiree for getting such advantage, and that premium is basically a cost towards goodwill of that business. which must be recognized as goodwill arising on acquisition or goodwill arising on business combination as per Ind AS 103. Now friends, this point may have some complications later on. So look into one thing: when you have acquired a business not by acquiring its net assets, but you have acquired control over another business by purchasing its equity, that is the situation where you will be the controlling entity and there will be a portion of the share capital of the acquiree which will be classified as a non-controlling interest. Then how do you measure the non-controlling interest? That also will be an important factor to be discussed. There can be different scenarios where you have acquired shares in another company, not at one shot, stage by stage. How to deal with that situation? So friends, I would want you to begin with one simple notion, that if you have paid anything in excess of the fair value of net asset acquired, that excess payment will be considered as payment towards goodwill of that business that you have acquired. In rare cases, if you are making a short payment, it will give rise to a gain arising on bargain purchase, which eventually gets transferred to capital reserve. But I don't want to discuss that situation of gain arising on bargain purchase right now. Let us focus on this heading, that is recognition and measurement of goodwill that arises in business combination and which arises on the date of acquisition. Once again, acquisition date becomes an important factor. Who is acquirer? Obviously that has to be considered for making all these calculations. So friends, what I am going to do is, I am going to give you a small note which you may not fully understand, because there is one line over there which I have yet to explain. Once you write down the notes, we will start taking up illustrative examples, and through those examples you will understand very well how to apply this concept. So please pay attention on the screen and let us write some notes and calculations. So as we have discussed, measurement of goodwill arising on acquisition, the acquirer shall recognize goodwill as of the acquisition date measured as excess of A over B, as mentioned below. A is the aggregate of three components. Number one, the purchase consideration, the amount of any non-controlling interest, and number three, the fair value of acquirer's previously held equity interest in the acquiree. Let me talk about this point, the aggregate of purchase consideration. Now purchase consideration, you have understood what it is. It is the payment for the acquisition of business. Now what is the role of this non-controlling interest and why it is being added over here? We will understand this through calculative examples. And then this line as well, the fair value of acquirer's previously held equity interest in the acquiree, even this has to be understood. So don't worry, we will understand each of these points through those calculative examples. But once you take aggregate of these three, your A is ready for comparison with B. And what is B? B is the net amount of identifiable assets acquired and the liabilities assumed. So it is excess of A over B, which will be considered as the amount of goodwill arising on acquisition. So friends, do one thing, before we go with those calculative examples, please note down what you find on screen. Alright friends, you would have finished writing these points. Let us move ahead and now take up some questions for understanding this concept. Now these are going to be very important questions, beginning from question number 23. A Limited purchased 80% shares of X Limited paying rupees 7,20,000. Fair value of identifiable assets of X Limited is rupees 9,80,000 and that of liabilities is rupees 1,80,000. Number of shares in X Limited were 10,000. As on the date of acquisition, the market price per share of X Limited is rupees 90. Find out the value of goodwill in the following situations. Number 1, non-controlling interest is valued at proportionate net assets, and number 2, non-controlling interest is valued at fair value. Now friends, when you get a question like this, the first thing that you are going to do is to consider the fair value of the identified assets of the acquiree, which in this case is given as 9,80,000. Also consider the fair value of liabilities that you have taken over, that is 1,80,000. So assets minus liabilities, the net asset of the acquiree, that is X Limited, that you have taken over is 9,80,000 minus 1,80,000, that will be 8 lakhs. Now the point is, look into another factor. Have you purchased the business or have you purchased shares of the acquiree? So the first line clarifies over here, you did not purchase the whole business, you have acquired control by purchasing shares in X Limited. As a result, the entire business does not belong to you. You hold only 80% of shares in X Limited. That means you are controlling X Limited definitely, but your share in X Limited is only to the extent of 80%. Balance 20% is minority or so-called non-controlling interest. Now friends, how much will be the value of goodwill will primarily depend upon how you are measuring non-controlling interest, and in this case we are going to measure non-controlling interest by two different approaches. Both of these approaches are allowable by Ind AS and you can use any approach as part of your accounting policy. So in your calculation initially, whatever you did, I am presenting the same thing on the screen, just pay attention to that. So first what you will do is, we are taking the first approach, that is when non-controlling interest is valued at proportionate net asset, the first part of the question. Fair value of identifiable assets of X Limited, it was 9,80,000 and fair value of liabilities of X Limited was 1,80,000. So the fair value of net assets of X Limited is rupees 8 lakhs. Now friends, before you write up this, please let me explain something very important. What you can clearly observe from what is given over here, net assets of X Limited that we have acquired, the overall net assets value is 8 lakhs, that is 9,80,000 minus 1,80,000. Fact number 1, we have not acquired the whole business, we have acquired only 80% of equity of X Limited. We have definitely established control. This is a business combination, but this is not a business combination by acquiring the entire business. It is a business combination achieved by acquiring control. Now 8 lakh is the value of net assets of the acquiree. We have acquired only 80% of its equity. So if you can look into one thing, the proportionate net assets. So 8 lakh is the net assets in totality. We have acquired 80%. So 80% of 8 lakhs would be 6,40,000, correct? And 6,40,000 is the value of net assets that belongs to us. The remaining part of the net asset, the remaining 20% of the net assets, that is 20% of 8 lakhs, that is 1,60,000, that will belong to the minority or non-controlling interest. So friends, if you can see, the entire net assets of X Limited is broken down into two components. The one that represents the controlling interest that we are owning, and the other part represents non-controlling interest that represents the other 20%. So what we have done, as per the first requirement, where the non-controlling interest is valued not at fair value but at proportionate net asset basis. So the total net asset value was 8 lakhs. Non-controlling interest is measured at 20% of that 8 lakhs, that is 1,60,000. So the part that belongs to us, that is the part that represents the controlling interest, the net asset proportion will be 80% of 8 lakhs, that is 6,40,000. Now, have we acquired 6,40,000 worth of net asset by paying exactly 6,40,000? Answer is no. We have paid 7,20,000 as per the question's information. If we have paid 7,20,000, it is clearly identified that we have made payment in excess of the fair value of net assets that belongs to us. Fair value of net assets that belongs to us is 6,40,000. Consideration that we have paid is 7,20,000. The difference between the consideration paid and the net assets that belongs to us, that difference will be definitely goodwill. So friends, what I am going to do is, let us not jump into writing the solution. Let me explain some basic workings so that concept is very clear, and then you can write up the exam presented type of solution. So friends, in this example, which is a very simple example, whatever steps, whatever presentation approaches I am showing you, please follow that carefully, and then only we shall move ahead. So let me just put on the screen what I have discussed with you. So what we have discussed by far, the net assets of X Limited is 8 lakhs, representing the fair value of these net assets. So what we first do is, these 8 lakhs worth of net assets of X Limited, we will split into two parts. Non-controlling interest is 20%, which will be 1,60,000, and the portion that belongs to A Limited, that is the acquirer, which is 80% of 8 lakhs, that will be 6,40,000. However, to acquire this much value of net assets in X Limited, A Limited did not pay 6,40,000. A Limited has paid something more than that. So consideration paid by A Limited is 7,20,000. Notice one thing, what you have paid is more than what you have acquired. That difference will definitely result into goodwill. So excess paid by A Limited, which we are calling as goodwill. Now friends, in examination you are not going to present the solution in this manner as I have shown on the screen, but right now for your understanding, please write down exactly what you find on screen. This may not be the exam presented solution, but very important for you to conceptually understand the whole subject matter. So please note down this, and then we shall move ahead. Alright friends, you would have finished writing this. Let us move ahead and now systematically note it down. When non-controlling interest is valued at proportionate net assets, fair value of identifiable assets of X Limited is 9,80,000. Fair value of liabilities of X Limited is 1,80,000, resulting into fair value of net assets of X Limited as rupees 8 lakhs. A Limited's share of net assets is 80%, that will be 6,40,000. So, non-controlling interest valued at proportionate net assets will be the remaining 20%, that is 1,60,000. So, purchase consideration paid is 7,20,000 and A Limited's share of net asset is 80%, that will be 6,40,000. Difference between these two is goodwill arising on acquisition. So, friends, first note down this whole thing. I will then talk about this little later. First, write this quickly. Now friends, what you find over here on the screen, even that is not an exam presented solution. In examination, you will write still lesser content and finish off the calculation in 1 minute. But what I wanted you to do is follow this procedure so that your concept is first of all fully cleared up. Now once your concept is cleared up and you have understood this calculation of goodwill, which is resulting to rupees 80,000, now follow a shortcut approach of making this calculation. You simply consider the amount of consideration that you have paid, that is 7,20,000. To that you add non-controlling interest, that is 1,60,000. And how we got this 1,60,000? Because non-controlling interest is to be measured or is to be valued based on the proportionate net assets. So net assets of acquiree X Limited was 8 lakhs. Proportionate net asset belonging to non-controlling interest will be 20% of 8 lakhs, and that will be 1,60,000. So what did I just say? take the amount of consideration that you have paid, 7,20,000. To that you add 1,60,000, that is the portion that does not belong to you. Now friends, you are measuring the non-controlling interest based on the proportionate net assets in this case. In any way, why are we adding these two components? Let us try to understand that logic as well. You are adding those two components, one which belongs to you, one which does not belong to you. So it is this way, the whole entity of that 80% belongs to you, for which you paid 720, and 1,60,000 is the portion that does not belong to you, so that also you have added. What belongs to you plus what does not belong to you aggregated becomes the whole thing, and that whole thing has cost of 8,80,000, and what we have obtained, the whole thing had a net asset at its fair value of only 8 lakhs. In other words, the cost represents little higher amount compared to the net assets of the acquiree. As a result, what you find difference between the two is nothing but the resulting goodwill. So friends, what I have just explained will be the approach that you will follow always in questions ahead. So what you have to do in a scenario like this, you first of all consider the amount of consideration that you have paid. To that you add the value of non-controlling interest. Now this aggregate you will compare with the net assets of the acquiree, that is X Limited in this case, and that difference, the aggregate, if it is in excess of the net asset, that excess will be nothing but goodwill. Now friends, one more important point that I should discuss before you start writing up the solution. What you should do is, you are aggregating two things, right? The consideration that you have paid and the value of NCI, that is value of non-controlling interest. In this approach, you have added non-controlling interest based on the proportionate net assets. In yet another approach, you will be adding the non-controlling interest also at fair value. If you do that, you will get little different value, but then it will be a different amount of non-controlling interest and a different amount of resulting goodwill. Understand one thing, as per Ind AS 110 and Ind AS 103 combined, both these approaches are permissible. Particularly, it is Ind AS 103 which governs this whole part. So friends, I am going to now show the exam presented solution, and then we will take up the other approach as well, where the non-controlling interest is measured at fair value. So this is how you are going to present the solution in examination. So first heading will be when NCI is valued at proportionate net assets. So what you will do is, purchase consideration that you have paid 7,20,000, you will start with this. To this you will add NCI, which is valued at proportionate net assets, that is 1,60,000. The aggregate of these two components, that is 7,20,000 plus 1,60,000, comes to 8,80,000. This will be compared with the fair value of net assets of the acquiree. Fair value of the net assets of acquiree, that is net assets of X Limited, is 8 lakhs. So I have told you to consider 8,80,000 as the cost, because this includes the cost that you have incurred. This 8 lakh is definitely the fair value of net assets. So difference between these two will represent the goodwill that will arise on acquisition. So that amount is definitely 80,000. In this question, because the objective was to learn the concept, we have shown the scattered working. From the next question onward, I will further systematically show how to present these workings in examination. Right now, quickly note down this before we switch to the next part of the question. Alright friends, you would have finished writing this calculation. Now look into one thing. You have dealt with the first part where the NCI is valued at proportionate net assets. If you would want to consider the second part where NCI is valued at fair value, there will be just one change now that you have to consider. What is that one change? This second line where you have taken NCI valued at proportionate net assets, in place of this what you will do is, whatever be the number of shares held by non-controlling interest or minorities, those who are 2000 shares multiplied by market price per share will give you NCI valued at fair value. Instead of 1,60,000, put that value and other things remaining same, you get goodwill arising on acquisition by that other approach. So I am showing how to present that calculation. You can just take note of that quickly. When NCI is valued at fair value, you will just start with the same thing, purchase consideration paid. To that you add NCI at fair value, that is 2000 shares multiplied by 90. Take the aggregate and compare that with the fair value of net assets of X Limited. This time the aggregate is 9 lakhs and the fair value of net assets of X Limited is just 8 lakhs. The resulting goodwill arising on acquisition will be considered as 1 lakh. So friends, quickly take note of this and then we shall move ahead. Alright friends, you would have finished writing this whole solution. Let us move ahead and now take up the next question, that is question number 24. Now friends, this question onward, I want your participation in solving the question. Raja Limited purchased 60% shares of Ram Limited paying rupees 525 lakh. Number of issued capital of Ram Limited is 1 lakh. Fair value of identifiable assets of Ram Limited is rupees 640 lakh and that of liabilities is rupees 50 lakh. As on the date of acquisition, market price per share of Ram Limited is rupees 775. Find out the value of goodwill. Show the accounting entry for recognition. Let us first analyze this question. So what we find is there are in total 1 lakh shares in this acquiry company Ram Limited, where the acquirer Raja Limited has purchased 60% of these shares. That means 60% of 1 lakh shares, in simple words 60,000 shares are purchased by Raja Limited and remaining 40,000 shares will represent the non-controlling interest or minority interest. Second thing, the question has not specified which method you should follow for valuation of NCI. I would recommend we should better follow both the approaches in this question. Anyway, we would want to practice out both the approaches. Next thing, what we find over here is, apart from the measurement of goodwill, the question is also emphasizing to show the accounting entry for recognition. So let us see how to go ahead with the solution. We would first follow the approach of fair value. So we should write the heading when NCI is valued at fair value. So what we do is, fair value of consideration paid is 525 lakhs, very clearly given. Next thing is NCI valued at fair value. So I have already mentioned to you 40% of RAM Limited's capital is held by minority, that is non-controlling interest. That would represent 40% of 1 lakh shares, that is 40,000 shares, and each share at fair value it is 775. So 40,000 shares multiplied by 775 would give you 310 lakhs. Aggregate of these two comes to 835 lakhs. Now the next thing that we would want to determine is the net assets of RAM Limited. For that, you just take the fair value of assets minus fair value of liabilities, and 640 lakhs minus 50 lakhs will give you fair value of net assets of RAM Limited, that will be 590 lakhs. So goodwill arising on acquisition will be excess of A over B, that is A minus B, and that is 835 minus 590, and that would be rupees 245 lakhs. So friends, this is where we have used the fair value approach for measurement of NCI. So first write up these calculations and then we show the recognition entry as well. Alright friends, you would have finished writing these calculations. Let us move ahead and now write up the journal entry for recognition at the acquisition date. So acquired assets are worth 640 lakhs at fair value. Now goodwill, what we have just measured, is rupees 245 lakhs. Consideration is 525 lakhs. Liabilities are at fair value of 50 lakhs, and non-controlling interest at fair value of 310 lakhs, being recognition of assets and liabilities of Ram Limited against the consideration. Now this consideration, as per the question, has to be settled in cash. So next entry will be consideration debit to bank, that will be 525 lakhs. So friends, please note down these entries as well, and then we move to the next part of the question, where we use the proportionate net asset method for determining the value of NCI. But first write up these entries. Alright friends, moving ahead and now taking the other approach, that is where NCI is measured at proportionate net assets. So this time what you will do is, you will start with the consideration paid, that is 525 lakhs, and this time when you add the proportionate net assets that belong to NCI, for that purpose you need to know what is the value of the net assets. And so what we do is, we first take the fair value of assets of Ram Limited, that is 640 lakhs, less fair value of liabilities of Ram Limited, that is 50 lakhs, and the net assets of Ram Limited will be 590 lakhs. So when you come up to this calculation, that is NCI at proportionate net asset, you are going to take 40% of this 590 lakhs. So 590 lakhs into 40%, that would give you 236 lakhs. So this time the aggregate of these two would come to 761 lakhs, and you know one thing, that goodwill will be excess of A over B. So simply A minus B will give you the amount of goodwill, and that will be 171 lakhs this time. So friends, it is exactly same way of presentation, just a little bit of difference in terms of determining NCI now at proportionate net asset basis. So I am giving you time, quickly take note of these calculations. Alright friends, you would have finished writing these calculations. Let us move ahead and write up the accounting entries. So I don't have to explain anything over here. It will be same set of entries with just one difference, that goodwill will be different and the value of NCI will be also different, because this time it is the proportionate net asset method which is being applied. So same entries, different values. In fact, the later part consideration entry will have no change, same entry, same amount. So take note of these entries and then we move ahead. Alright friends, you would have finished writing these entries. Let us move ahead and now take up the next concept, that is business combination, which is achieved in stages. This is also known as step acquisitions. Now friends, in this regard, consider a situation that the acquiring company did not acquire shares in the acquiree at one go. That means it has acquired shares in stages. Assume that it has purchased 25% shares in one lot, then another 20% shares in the second lot. So 25 plus 20 makes it 45%, and maybe another 30% in the next lot, where it cumulates to 75%. So did you notice one thing, that finally the control was achieved only at the third stage of acquisition. So shares were acquired at different dates. That means shares must have been acquired at different prices, correct? That means after acquisition, the carrying amount of the investment would also have undergone changes because of fair value changes. So friends, how would you deal with a scenario like this? Point number one, when you have acquired shares in different stages, the acquisition date will be the date on which the control is achieved. So in the example that I just gave you, it will be the third stage of share acquisition which will be considered as acquisition date, because that is the date on which the control is obtained. Second thing, obviously the price at which the shares have been purchased or the fair value of the shares prevailing at the acquisition date may not match with the carrying amount if the acquisition is happening somewhere at the mid of the year, it is possible that the investments have been carried over at some previous fair values and current date's fair value has not been affected. So what you need to do is, number one, remeasure your existing equity interest in the acquiry. That means your old equity interest what you have acquired earlier in the acquiry company, that has to be remeasured at the acquisition date fair value. Obviously the existing carrying amount and fair value, if they have any difference, that difference can represent either a gain or a loss. That gain or loss will be recognized through P&L. However, there could be an exceptional case where such an equity investment is carried over at fair value through other comprehensive income. That is how it has been designated earlier as per Ind AS 109 or maybe as per Ind AS 28. However way you are carrying that, if that investment has been carried over at fair value and the fair value changes have been recognized via OCI, that is other comprehensive income, then you continue to do the same thing. In such case, any gain or loss on remeasurement will not be recognized in the statement of P&L and will be recognized via OCI. So friends, what I want you to understand is, you should be very clear with facts that when the acquisition is done in stages, the date of acquisition will be the final date when the control is acquired. All your earlier investments will be remeasured and the resulting gain or loss on that remeasurement at fair value at the acquisition date will be recognized through P&L and in exceptional cases through OCI. So whatever I have just discussed, I am showing the same thing on the screen. Please take note of that, and that will be followed by an illustrative question in this regard. So your attention on the screen please. So we are talking about business combination achieved in stages. In a business combination achieved in stages, the acquirer shall remeasure its previously held equity interest in the acquiry at its acquisition date fair value and recognize the resulting gain or loss, if any, in profit or loss. In prior reporting periods, the acquirer may have recognized the changes in value of its equity interest in acquiry in other comprehensive income. In such case, the resulting gain or loss, if any, will be recognized in OCI. So friends, first of all, write up these points and then I will give you notes further. Alright friends, you would have finished writing this. Let us move ahead and write some more important notes in this regard. Point number 1. In case an entity acquires another entity step by step through series of purchases, then the acquisition date will be the date on which the acquirer obtains control. Till the time the control is obtained, the investment will be accounted as per the Ind AS 109 or Ind AS 28, depending upon the type of the investment. When a party to a joint operation obtains control of a joint operation business, the transaction will be considered as a business combination achieved in stages. So friends, quickly take note of these also, and then we shall move ahead. Alright friends, you would have finished writing these important notes. Let us move ahead and solve questions of this type. So let us begin with question number 25. Let us read this question. During 2016, A Limited had purchased 2000 shares of X Limited at cost of rupees 60,000. On 1/4/2020, A Limited further purchased 6,000 shares of X Limited at prevailing market price of rupees 90 per share. On 1/4/2020, fair value of assets of X Limited is rupees 8 lakh and that of liabilities is rupees 2 lakhs. Total number of shares in X Limited were 10,000 shares. Find out the value of goodwill if non-controlling interest is valued at fair value. So friends, what you have to do now in this case, you have to first of all consider one thing, that originally there were 2000 shares that you have acquired in X Limited, and then at later date you have further purchased another 6000 shares in X Limited. So finally you hold 2 plus 6 8000 shares in X Limited out of its total 10,000 shares. So you have in total 80% shareholding in X Limited. At the early stage you just hold 20% share, that is 2000 out of 10,000. So control is definitely achieved on 1/4/2020 without doubts. So what you have to do is, your old acquisition, this will be remeasured at the acquisition date at its fair value, and finally you will work out the resulting goodwill. And here the question is asking you to measure the non-controlling interest at fair value. So basically, how do you present your solution in this case? There will be one additional point that you have to consider. You will first of all consider the fair value of consideration paid, but this includes only and only the fair value of those 6000 shares which you have acquired at the acquisition date. What about the older acquisition? That also you have to measure at the fair value of this date, that is the acquisition date, and that will be 1,80,000, that is 2000 shares into rupees 90. And non-controlling interest will be measured again at fair value as per the instruction given in the question. So even that will be 1,80,000. So when you take the aggregate of these, you get 9 lakhs as A. Now one thing that you should consider, this old acquisition, these 2000 shares that were acquired earlier, they were purchased just at 60,000. We have no information about the carrying amount of those. So in absence of information, we are assuming that those shares were still carried at 60,000 and now they are remeasured at 1,80,000. So gain on previously held equity interest will be 1,80,000 minus 60,000, that will be 1,20,000. This gain will be recognized in the statement of P&L. So before I take you ahead, quickly take note of these calculations. Alright friends, you would have finished writing these calculations. Let us move ahead and now work out the amount of resulting goodwill. For this purpose, what you need to do is you have to find out the net assets of X Limited, and for that the fair value of assets of X Limited is 8 lakhs and fair value of its liabilities is rupees 2 lakhs. So the net assets at fair value is 6 lakhs and the goodwill arising on acquisition will be excess of A over B, that is A minus B, and that will be rupees 3 lakhs. So friends, take note of this whole thing and that will be end of the solution. Alright friends, you would have finished writing these calculations. Let us move ahead and now talk about gain on bargain purchase. Now friends, regarding gain on bargain purchase, first of all let me tell you one thing. This would be a rare case scenario. Why a rare case scenario? Because gain will arise only when the value of net asset is more than the amount of consideration paid, correct? So try to recall what used to happen in case of goodwill. In case of goodwill, you pay more value as compared to what you acquire. So gain will arise in a reverse scenario, and that is why it will become an exceptional scenario, a rare case scenario. Why a rare case scenario? Because when you are acquiring a business, it is obvious that you might pay some premium over and above the fair value of net assets. But why would you pay less than assets fair value? That means if you are paying something less as compared to fair value, that means the seller must be under some kind of force or some kind of compulsion to enter into this kind of negotiation to face a loss for itself and giving benefit to the acquirer. So this is generally a forced kind of sale. Forced kind of sale means I am not saying that you are threatening someone and acquiring their business. Forced kind of sale means, for example, someone has incurred heavy losses in the business and that entity wants to get rid of the business and therefore willing to now just dispose of all assets and liabilities at whatever best value they can get, but they would want to wind up the business as early as possible. So this could be a case of forced sale. Another situation, suppose a research institute, whatever kind of medicines it was researching into, those medicines and those type of research have been banned. So what will happen? Those all research facilities now have no other use. Obviously, what will be done? This whole research facility will be sold out at something very less as compared to its fair value. There can be multiple examples of situations where we can have this kind of scenario, that is the forced sale, but the scenario itself could be a rare scenario. So friends, basically you have to just make same approach of calculation what you follow for measurement of goodwill arising on acquisition or goodwill arising on business combination. What I just told you, keep in mind that this is a reversal scenario where amount of net assets will be more than the consideration that you are paying. So let us write some important notes in this regard and then followed up by question solving. So as we have just discussed, gain on bargain purchase, in extremely rare circumstances an acquirer will make a bargain purchase in a business combination in which the net assets value acquired in a business combination exceeds the purchase consideration. The acquirer shall recognize the resulting gain in OCI on the acquisition date and transfer the same in equity as capital reserve. That means eventually the gain on bargain purchase will be transferred to capital reserve. A bargain purchase might happen, for example, in a business combination that is a forced sale in which the seller is acting under compulsion. So friends, quickly take note of these and then we go ahead and solve questions. Alright friends, you would have finished writing these notes. Let us move ahead and take up question of this type. That will be question number 26. Let us read this question. On 1/4/2020, A Limited purchased 8,000 shares of X Limited at prevailing market price of rupees 60 per share. On 1/4/2020, the fair value of assets of X Limited is rupees 10 lakhs and that of liabilities is rupees 3 lakhs. Total number of shares in X Limited were 10,000 shares. Find out the resulting gain on bargain purchase if non-controlling interest is valued at fair value. So friends, basically you have to make the same type of calculation, the way you approach goodwill calculation, exactly same way. This will be just a reverse case where the value of net assets is more and the consideration is less. So let us see how to write up the solution. In your solution, you would first start with the fair value of the consideration that you have paid, that will be 8,000 shares multiplied by rupees 60, and that will be 4,80,000. To this you will add the fair value of non-controlling interest, that is NCI valued at fair value. So it is now 2,000 shares multiplied by same price per share, that is rupees 60, and that will give you 1,20,000. This aggregate comes to rupees 6 lakhs. Now we have to find the fair value of net assets of X Limited, that is the acquiry company. So assets of X Limited were 10 lakhs and liabilities were 3 lakhs. So fair value of net assets comes to 7 lakhs. Finally, the gain on bargain purchase will be excess of B over A. This is a reversal scenario, don't forget. For goodwill calculation, we have always been computing A minus B. Here it will be B minus A. So the resulting gain on bargain purchase will be rupees 1 lakh. So friends, please take note of this, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. So with all these learnings, my recommendation to you is very clear, that you must very well revise and practice this concept, because this is going to be the base of this chapter. If you are not good at these things, you will be into troubles ahead. So time for us to put an end to this session. Let us declare this as end of part 3. Thank you so much for attending this class.